This is Brian Nelson from Valuentum. Can things really stay this good? It's a question I keep asking myself. For starters, the investment landscape has changed quite a bit over the past decade. Years ago, interest rates were near zero, and an intense focus on dividends may have made a lot of sense. Interest rates are now much higher, and that means risk-free assets offer yields that are a multiple of that of the yield of the S&P 500. The markets in this regard are starting to make a lot of sense, as high-yield dividend aristocrats, as measured by the SPDR S&P Dividend ETF SDY, have suffered a difficult year so far in 2023, down roughly 3% compared to the market cap weighted S&P 500 return of 20% plus, both measures on a price-only basis. I think shares of many high-yield dividend aristocrats will likely remain depressed until risk-free rates fall below that of the average S&P 500 company again, which may be a long time and likely occurring in a difficult market environment overall. In the meantime, other areas will likely have performed much better than this group. We're just not living in a near zero interest rate environment anymore, and it might be very likely that the expected returns on many dividend-paying stocks in the next few years may be just their dividend yield itself as they continue to stagnate. The consumer staples sector, for example, trades at nearly 19 times forward earnings, and many of them hold net debt on their books. Could we see a multi-year drought in capital appreciation for many dividend payers and growers? Perhaps. That said, many investors in dividend aristocrats are focused on dividend growth, and I don't think many companies, save for a couple, maybe Air Products or Walgreens, will disappoint on this front in the near term. So in this regard, things should be okay for this cohort of investors, as capital appreciation and total return may be a secondary condition for them. So far in 2023, the area of large cap growth, as measured by the Schwab Large Cap Growth ETF, ticker symbol SCHG, has outperformed the dividend aristocrats, the high yield dividend aristocrats, ticker symbol SDY, by nearly 50 percentage points so far in 2023. We've been pounding the table on the stylistic area of large cap growth for years now, a key theme in the second edition of my book, Value Trap. One could have made a career out of betting on large cap growth stocks during 2023. The media has now popularized this group as the Magnificent Seven, but we've been early and we've been right. Let's talk about the simulated newsletter portfolios, which always highlight our best ideas constructed in a diversified portfolio. We use the Valuentum Buying Index, not by itself, but instead to help inform the ideas that we consider in the newsletter portfolios. This is an important dynamic, as the VBI should be viewed as just one input of the Valuentum process. On a price-only basis, the Dividend Growth Newsletter portfolio has outperformed high-yield dividend aristocrats, as measured by the SDY, by approximately 8.8 percentage points from the beginning of 2022 through the close of November 30th, 2023. The portfolio benefited from the strength in ExxonMobil and Chevron in 2022 and our overweighting of large-cap growth in 2023. I give this simulated Dividend Growth Newsletter portfolio's positioning over the past couple years an A+. Let's now talk the Simulated Best Ideas newsletter portfolio. I'm hearing that some of our customers have generated equity returns of 28% so far in 2023. That's roughly 8 percentage points in excess of the return of the S&P 500 on a market cap weighted. And nothing makes me happier than to hear success stories such as these. From the beginning of 2022 through the December 1st close, we estimate that the Simulated Best Ideas newsletter portfolio is in the green, generating approximately 4.4 percentage points of outperformance relative to the stubborn and tough-to-beat market cap weighted S&P 500. This outperformance includes some of the ideas that didn't quite work out as well, perhaps no one more prominent than Meta Platforms. It goes to show that one can have a few ideas that don't go your way and still beat the market. Now on to the Simulated High Yield Dividend Newsletter portfolio. It now sports an estimated forward dividend yield north of 7% and has benefited from exposure to energy during 2022, as well as the buyouts of Life Storage and Magellan Midstream earlier this year. We continue to expect to pursue ideas higher than the portfolio's yield going forward to further increase the magnitude of the portfolio's estimated income generation. Derivative income ideas from JP Morgan, such as the JEPI and the JEPQ, two ticker symbols that we recently added to the high yield dividend newsletter portfolio. These two remain two of our favorite portfolio ideas at this time. For those interested in high yield dividend investing, the high yield dividend newsletter is worth considering. We're loving what we're seeing across the newsletter portfolios, but the exclusive publication is probably doing the best of all. The success rates in the publication through the release of the November edition on November 8th have been absolutely phenomenal. 81 out of 88 short idea considerations have worked out, good for a success rate of 92%, while capital appreciation ideas have put up a success rate of 85.2%, 75 out of 88 ideas working out. If you're looking for an income idea, a capital appreciation idea, and a short idea consideration every month, the exclusive publication is worth considering. I believe it is the most valuable financial publication on the market, and the success of the ideas through both bull and bear markets speaks loudly to the quality of all of our work across the board. Let's now talk about the market environment. One thing that has changed over the past decade or so is just how heavily government agencies are involved in the markets. We learned through Greenspan to flood the markets with liquidity following the dot-com crash, and with Bernanke when he did the same during the great financial crisis. But Powell took things to another level during COVID-19. We nailed the COVID-19 crash in 2020 and the massive bull market run in 2021, but the course of these events has fundamentally changed our risk assessment for equities. We now believe that black swan scenarios, already low probability events, will only be short-term in nature with little lasting impact. Another Great Depression is just no longer in the cards in our view. What that means is that the proposition for equity investors, which already is tilted in their favor in the long run, is now even more favorable in a post-COVID-19 world. What gave us the conviction to stick with the massive bull run from the COVID-19 bottom in March of 2020 through today is precisely for this reason. It has paid off nicely. We still believe 2022 was an aberration that was corrected in 2023, but the past 18 months were a long time to be proven correct, an eternity when we're publishing 60 newsletter editions a year. But the point remains, betting against the equity market for even more than a couple years is probably the wrong move. With that in mind, things are good right now, great even. From what I can tell, this economy is booming even when interest rates are where they are. People are spending money and spending it like mad, but is it sustainable? Well, there are four major concerns that come to mind. The first is personal credit card debt, which is soaring. The second is excess savings, which is falling. The third is the resumption of student loan payments, and the fourth is the housing market, where prices remain resilient despite higher rates. Offsetting these dynamics, however, has been the strength of the job market, both with respect to wage gains and low unemployment rate, and the massive wealth build during the past several years. Wage gains are plateauing at a mid-single-digit pace, and unemployment rates remain subdued at structural lows of 3.9% as of October. Such a duo has padded the pockets of U.S. households that seem to be all too willing to keep spending their money. Anecdotally, it looks like vacation destinations are reaping in the cash, and while measures of consumer sentiment aren't great, it's certainly not because wage growth and unemployment rates haven't been solid. Inflationary pressures are also easing, and some retailers, such as Walmart, are even talking about disinflation and deflation on some items. Employers continue to have a hard time finding help to meet consumer demand that is being propelled by the very wage gains that are eating into their cost structures. We think many employers are concerned that if they start to run too lean, they'll end up letting go of some of their best workers, and they may not be able to find replacements. The COVID-19 bust and subsequent boom put employers in a position where layoffs could inhibit growth, leaving the U.S. economy in a situation today where more people are employed at much higher wages. The consumer, therefore, continues to be in a really strong place to continue to spend to propel the U.S. economy, in my view. The 37% increase in median net worth the past 3 years has helped too. With risk-free yields where they are, wealth is generating a nice return even if they are just parking their assets in certificates of deposits these days. Today, I feel like we're right back to where we were at the end of 2021. Large cap growth is booming. Small cap value is trailing. Dividend payers are stagnating. The markets are making a lot of sense again. But I do have my worries. When things are going this well, some market choppiness is probably in the cards. The market cap weighted S&P 500 is now bumping up against the high end of its downtrend, so the remainder of this year will likely see some increased volatility. I'm also worried about a market rotation into the equal weight S&P 500, which may prove to be a headwind relative to our favorite ideas within big cap tech and large cap growth, which will have come off a very strong, if not fantastic, year in 2023. On the back of NVIDIA's momentum and the great promise of artificial intelligence, however, I believe the first half of 2024 will be awesome, followed by a very difficult back half of 2024, as some of my concerns finally catch up to the markets. But that just might be at the time the Fed starts cutting rates to support equities. Now on to our top ideas for 2024. We picked one for each sector. And please be sure to visit the website for more information on these names. In pharma and healthcare, we love Vertex Pharma because of its cash-rich cystic fibrosis program and its pipeline that deals with pain management and CRISPR gene editing technology. In energy, we like Phillips 66, which is benefiting of late from activist involvement. In financials, we like the Financial Select Sector SPDR because of its diversification across the sector, leaving little exposure to any one bank, and that's ticker symbol XLF. Phillips 66 is ticker symbol PSX. In industrials, we like Republic Services, ticker symbol RSG, thanks in part to its robust free cash flow and hard to replicate asset base. In tech, we like Microsoft, ticker symbol MSFT, due to its lead in artificial intelligence and tremendous operating cash flow trajectory. In real estate, we like Public Storage, ticker symbol PSA, as the firm has shown in the capacity to generate positive traditional free cash flow as measured by cash flow from operation less all capital spending, unlike almost all other REITs. In materials, we like Albemarle, but we reiterate that we don't like the materials sector very much in aggregate, and we view it as an area to avoid. In consumer discretionary, we like Booking Holdings, ticker symbol BKNG, and think shares are super cheap. We like NextEra Energy, ticker symbol NEE, with respect to utilities, but as with the materials sector, we're not too fond of the group and view it as an avoid. In consumer staples, we like Pepsi as we see valuation upside, and in communication services, we like Alphabet, ticker symbol GOOG, given its dominance in search and valuable assets such as YouTube. All told, I hope you have enjoyed our work thus far in 2023, and congrats on sticking with it. Let's keep a close eye on things, but for now, it's my view that the bias through mid-2024 remains higher in the equity markets. This is Brian Nelson from Valuentum. Thank you so much for listening.